With 2017 nearly in the rearview mirror, what can investors expect in 2018? Welcome to Trading Nation. I'm Eric Chemi. Today we're joined by Steve Chiavarone. He's a portfolio manager at Federated. Steve, it's nice to chat with you here.
Eric, great to be here.
So let's get right into it. What's your year-end target for the S&P 12 and a half months from now?
Yeah, so we're towards the street high. We've got a 3,000 target for the end of next year. We expect that this bull market continues to have legs.
And what gets you do you build that from a top down or a bottoms up? How do you get to that number?
Yeah, I mean, we try to do it the old-fashioned way, which is, earnings number times a multiple. When we look at earnings from the bottoms up or the top down, or what we like to call a kind of a consensus decay rate. So how much does the final earnings number fall from where consensus is today? Well, unlike most years, we think that the actual earnings number is going to come in above analyst expectations. Analyst expectations have been rising all year. That doesn't happen often, but it does happen. And when it does, we're usually about 3 to 4% below the final number at this point. When you throw in tax reform, which looks like it's going to hit in 2018 rather than be delayed to 2019, we think we're in for an earnings number that's $150 or maybe even slightly north of that. And then we think that, despite folks worried that the market is expensive, and we recognize it's not certainly dirt cheap, market multiples don't fall unless you're in recessions. We do not see a recession in 2018, and therefore we think that the multiple continues to expand. So a 20 times multiple on $150 in earnings appears to be completely reasonable to us.
Because I was going to say, that was going to be my next question, is where's the volatility? Is it more from that earnings number, or is it more from that PE number? Because obviously, as you know, you can move each of them just a little bit, and the next thing you know, the whole market price is totally different. So I always wonder, historically or from your experience, which one tends to move more?
Well, I think earnings is the science of our business, and the multiples the art. Because the earnings, there are things that you can tally up. There are things that you can model. And in fact, we do that 3 or 4 different ways. But the multiple is an assessment of what's the mood of the market. How's the market going to respond? But what we do know is that the market multiple on average rises around 1 turn a year when you're not in recession. We know that earnings grew this year north of 10% without a dime of stimulus. And so, the underlying trends in the economy are good. We expect that to continue to be the case. And there's some add-ons here, and I think tax reform is one of them, deregulation's another. And so we feel pretty good about our forecast.
Obviously, you think that there's going to be 2 hikes next year. A lot of people think 3 hikes. How do you get to that? Because obviously it feels like 3 is the more common.
Yeah, so I think the reason why we expect 2 is just inflation continues to fall below the Fed's forecasts. And I think technology is a big driver of that, quite frankly. There are disruptions that are occurring in the economy, and most of those are deflationary. Companies are becoming more efficient. They're becoming less labor intensive. And while wage inflation is occurring, and we expect it to continue to build, we just think it's going to be slower than the Fed expects. And so we think they'll be sensitive to a flattening yield curve. We expect the yield curve to steepen later in the year, but in the early months, we think they'll be sensitive to some flatness in the yield curve. And we think that they're not going to want to cut this off too early. And so we expect that while they would certainly love to be able to do 3, inflation is going to hold them at 2.
So does that hurt something like the financial sector if they are looking for 3 hikes, maybe they only get 2?
See, historically, you'd say because you'd say, you get a net interest margin boost with higher rates. But I think there's some mitigating factors that are important. First, Jerome Powell, it's clear to us that he's going to exert less regulatory pressure on the financials. And I think you'll see that in return of capital. I think he's going to allow them to boost the dividend. I also think that these banks, especially the big banks and the regionals, are going to benefit very much from tax reform. These guys have effective tax rates close to 30%. And then also, dividend investors used to really invest in this sector in a big way, but couldn't when those dividends were cut in the Great Recession. Well, they've clawed their way back. And I think as you go through 2018, you're going to see a host of names pop over that 3% dividend yield. You're going to see a new class of investors come in. And they're going to look attractive at 15 or 16 times earnings versus staples that are 19 or 20 times earnings.
All right, let's move over to talk about technology right now. Obviously, having a great year, or many years, right? Like, when does when does this end?
Tops are always much harder to call than bottoms, but I think what you can look at is, are the fundamentals real? So while the sector's at an all-time high, its PE ratio is not. This is being driven as much by earnings as it is enthusiasm, and that's real. We've talked about in prior appearances on this show that we think we're in the middle of an industrial revolution, and it's driven by tech, by automation, by AI, by the Internet of Things. And so I think the market's really understanding that value. I think in the years past, because growth was so low everywhere else, maybe there was a little bit more of a premium to pay for that growth. Maybe if growth picks up, it's not the leading sector the way we think financials could be, but we expect that it continues to have strength. There's just good underlying fundamentals.
All right, so then finally, let's put all this together. Let's say here we are at the end of the year. A lot of people are dealing with, oh, what's going to be in my 401k for next year? What's going to be a deferred comp question? A lot of these retirement account kind of questions. So let's say if they're just thinking in that longer term, 1 year at a time trading, what is a portfolio for somebody like that in terms of stocks, large cap, mid cap, small cap, some bonds, some international, some dollars, some gold? How would you put something together right now?
Yeah, I mean, that's what we do in our fund. And so, the way we think about it is a 60-40 starting point, 60% equities, 40% bonds is a good starting point. We'd be slightly overweight that, somewhere in the range of 4 to 5%. We would certainly be overweight international equities. We think they're a couple of years behind in their recovery. We think small caps are particularly attractive because, again, their tax rates are higher and they're doing a lot of domestic business, more so than the large cap companies. So we see opportunities there. And then in terms of kind of growth versus value, value cyclicals, financials, industrials, materials, those parts of the market that are going to benefit from 3% GDP growth, we think represent some real interesting opportunities. So that's essentially how we would think about portfolio construction right here.
Awesome. Steve, thanks for joining us here on Trading Nation.
It's great to be here. Thank you so much.
All right, so that was Steve Chiavarone. He's a portfolio manager at Federated. I'm Eric Chemi. We'll see you next time.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.